securities lending. It's in the news lately, and not for good reason. It's roiled the markets, and I can't think of a better person to talk to about securities lending and what it means than Jeff Snider, the head of global research for Alhambra Partners. Jeff, good morning. Nice to see you again.
Good morning, Emil.
We're going to be talking about an essay that you wrote for Real Clear Markets that was posted on the 12th of March, 2021, and it's titled Seeing Interest Rates Counter to What They Actually Are. And we're going to start with money dealers. And you asked that question, Jeff. You say to begin piecing together the answers, we have to start first with money dealers. You explained to us here that they intermediate in money markets and money markets. And I understand what each of those individual words mean in isolation, but can you help us? What does it all mean when you string them together like that?
Well, I think we have to be clear, first of all, what we're talking about. Now, money dealers is a much broader concept than maybe perhaps people are familiar with the term primary dealers. Maybe even think about primary dealers when you hear the word money dealer or hear the term money dealer. We're talking about money dealers in a broader sense. Primary dealers are just the banks that have been privileged to do business with the Federal Reserve, and that includes U.S. subsidiaries of foreign banks, because we do have a global monetary system. Now, what we're talking about here, and usually when we specifically reference money dealers, is any banks that participate in these markets and do some of these activities. It doesn't matter if they're transacting with the Fed or not, and it doesn't have to be domestic subsidiaries of foreign banks or even just U.S. banks. It can be any bank around the world that operates in these offshore markets, that have a brass plate in the Cayman Islands down by you, for example, Emil. It's anybody who has the ability to transact with other banks in that offshore marketplace and to provide them with money dealing functions. As the term itself implies, money dealing and functions, there's a lot to it. It's not just, hey, I'm going to store some cash in a vault and give it to you when you want it. In fact, as we're going to talk about here, there's no cash at all in most of this stuff. It's money dealing activities and functions that are provided by these banks.
Precisely, Jeff. They're not called currency dealers. They're called money dealers. And there's a difference. And as you tell us, there's a lack of any actual currency in what they're doing. There's practically none of the physical Federal Reserve notes or any paper dollars of any kind. And that's hard to imagine, money dealing without any paper, without any currency. But you help walk us through this idea, this hard to grasp concept, with an example of a bank in Singapore and a bank in the Cayman Islands. It sounds like a bedtime story. Tell us this tale.
Yeah, it's a riveting tale of money dealing across the world. No, look, you're exactly right. And I think people have a conception of money as you just said, it's currency. There's physical Federal Reserve notes in some vault somewhere, and a bank hires a bunch of guards and armored trucks and planes and things, and pallets of cash move back and forth. When it's further from it, that could not be further from the truth. There is a piece of paper involved, and it's a bookkeeper's piece of paper, but that's the only piece of paper. There's no actual currency. It's a bookkeeper's pen that keeps ledger entries back and forth, essentially trading and transacting in IOUs of all kinds of forms of IOUs, essentially. And if we think about, as I wrote in the article, a company in Singapore who has to do business in the global marketplace, because Singapore obviously is a city, doesn't really have access to all of the types of economic resources it might need. So having to participate in the global marketplace means you have to have the global currency available to you in order to transact in that marketplace. So a company in Singapore is going to need dollars to buy anything, because the Singapore dollar, as prestigious as it is, simply won't fly in most parts of the world. Nobody's going to take Singapore dollars for transactions. So this company in Singapore needs to find dollars from somewhere. So it will contact another local domestic bank in the island of Singapore and say, look, I need some dollars because I got to buy something from somewhere else outside of the city. And that bank say, I'm going to look in the offshore Eurodollar market, finds a transacting or a counterparty, maybe in the Cayman Islands, since that's a major Eurodollar offshore hub, and says, look, I need dollars to provide this company so that it can go off into the marketplace and buy real goods and services in the real economy. And the Cayman Islands bank says, well, I don't have any dollars either, but I can get them if I want to. So is my promise good enough for you?
Yeah, okay, good. So when you say they don't have any dollars, we know they're not talking about these dollars, the
Right,
physical dollars,
right.
but they may also, you say, not actually have the dollars, and all they're offering is a claim that they'll be able to. Is
Right.
that
So you
right?
think,
And
hey,
they're
this is a bank that's in the Caymans. It's been operating in this market forever. So if I ever needed to come up with the actual physical currency, what better company to transact with? So the Cayman Islands Bank doesn't have dollars. It realizes it doesn't need dollars. It's basically trading on reputation and trust. And it says, look, if you need physical currency, I can get it for you. But what do you need physical currency for when my promise is good enough? So the bank in Singapore now has a claim, or actually has given a claim to the bank in the Caymans, and the bank in the Caymans now has a claim on the bank in Singapore.
now the cash lender, you say, is relieved of any obligation for physical paper, and instead of their ability to exchange this claim depends on several factors. And now here it gets into some interesting math. You're saying that some of those factors are mathematical descriptions, volatility, loss probabilities. Tell us a little bit about the Cayman Bank and how it feels comfortable that it can promise to deliver dollars to
Yes,
Singapore.
let's be specific here. What happens is the bank in the Caymans, as the cash lender, again, there's no cash, it's simply an asset.
Yeah.
But as the dollar lender to the bank in Singapore, it has essentially created an asset. That's the claim. I now say I've lent dollars to Singapore. Now I have a claim on Singapore to repay them over whatever the contract specifies, including interest and maturity and all those kinds of things. But in order for the Cayman Islands Bank to make that loan, to create this asset, it has to pass muster in all of its balance sheet mechanics, which is, what's the risk of making this loan? Because banks in the Cayman Islands are not going to just make loans for to anybody for no reason or for any reason. They have to have this lending arrangement has to meet certain criteria that the individual bank in the Cayman Islands has set for its own balance sheet. And those usually relate to not just creditworthiness, but also volatility and things in the marketplace, because in this modern quantified world, even interbank loans like this are given some sort of volatility. We have to model the present value of this loan to fit it into the asset side dynamics of balance sheet construction. And so it's really for the Cayman Islands Bank, it's okay, I'm going to create an asset, and how does that asset look, or how does it fit into my own individual balance sheet constraints? And if it fits in there relatively easily, then there's no problem here. We'll just do the loan and everybody will be happy.
Now, Jeff, two words I didn't hear from you right now were Federal Reserve. The Cayman Bank at no point was thinking, well, what does the Federal Reserve have to say about me lending dollars to Singapore, US dollars? They don't come into it because it's a cashless system, right? I guess if they were shipping Federal Reserve notes, then they would have to get Federal Reserve notes, but they're not. And that's one of the key points of this whole series. The Federal Reserve didn't come into this consideration. It was individual idiosyncratic bank balance sheet considerations. On the lender side, what about the counterparty in Asia? Are they going through similar considerations?
Now, on the other side, the bank in Singapore now has a liability, a U.S. dollar liability to the bank in the Cayman Islands, which it agrees to pay back under certain circumstances and under individual terms that have been worked out. And you're absolutely right. Because it's a bank in Caymans and a bank in Singapore, this has nothing to do with the United States whatsoever, not just the Federal Reserve. It has absolutely nothing to do with the United States whatsoever, even though this is a U.S. dollar denominated asset and liability. And so it's dollars, but it's not really dollars. And of course, there's no physical currency either. So it's really kind of a virtual reserveless currency system that operates on absolutely like virtual principles. And so, on the other side, the bank in Singapore also has to make sure that this liability fits within its idiosyncratic factors for funding. Because when you're putting together a balance sheet, it's not just assets or liabilities, it's about how those two things fit together. Because remember, the bank in Singapore is intending to make a loan to a company, which is usually longer term. So if I'm arranging, say, a short-term overnight loan that I intend to roll over with the bank in the Cayman Islands as my source of funds for that loan, I have a liability mismatch potentially that I need to be aware of. And so these are bank factors on each side, the liability side and the asset side, that have to match in order for this transaction to happen.
Now, you say that governing much of these individual transactions are modern conventions of mitigation, instruments, and methods. And I'm going to make that synonymize. I'm going to translate that into risk management. Is that right? And I think here we're going to draw a line between the pre-2008 financial system and the post-2008 financial system, because before 2008, it seems like they would be able to conduct this transaction and maybe offset, risk mitigate it with derivatives, with credit default swaps. Whereas after 2008, that seems less prevalent, less used. And now we need to now the borrower needs to put up collateral. And that leads to a whole lot of problems.
Well, it's interesting because when you do draw the line between pre and post crisis, the 2008 crisis, in the pre-crisis period, you were talking about the Federal Reserve, where does it come into it? That's really where it came into it in the pre-crisis period, because if I was the bank in the Cayman Islands and you were the bank in Singapore and we're doing this transaction, we would, unsecured transaction overnight, whether, overnight or even at a term, we thought that was before 2007, we thought there was really no risks to it. I knew you, you knew me. And so we just engaged in this transaction. We didn't really care about it because we thought, well, this is an easy thing. We have reputations established. And if anything goes wrong, I can always borrow in federal funds or even go to the discount window of the Federal Reserve if I have to in order to keep this thing going. It was perceived to be so low risk, it didn't matter, essentially. As long as we kind of knew each other, we'd seen each other operate in the marketplace, there didn't need to be any kind of security, and it fit into any kind of balance sheet either on your side of the liability side or my side on the asset side, because it was perceived to be the lowest of the lowest form of risk. And so it was very easy to put it onto a balance sheet.
But now that risk has changed, and now you need collateral. Except, guess what? Collateral is just not laying around freely in Singapore. They don't have any spare US Treasuries or German bonds or whatever kind of collateral they can put up. So if the Cayman Islands Bank says, we're living in a post-2008 world, we're good friends, but I can't just lend this money to you uncollateralized, unsecured. I need some collateral from you, Singapore. Where is Singapore going to get the collateral to satisfy the request?
Yeah, and that's an important point too, because as I'm putting together my balance sheet, I want to do this loan to you, but the way I model that loan nowadays, mathematically, it's not the same as it was pre-crisis. Now there's some risk there. I now have to incorporate some risk there, which means it's more balance sheet intensive. It soaks up more balance sheet space to do this loan when it's perceived to be riskier. So it might be that, I say to you, Emil, I know we've been doing business forever, but my balance sheet constraints have changed. I now look at you. I don't look at you specifically in business as risky, but the math does. The math says we've had nothing but problems for the last 10, 12 years. And I'm sorry, man, but unless we have something to mitigate the risk and to reduce it in the modeling, I can't fit it on my balance sheet the way I would like, unless I charge you an enormous rate to make it profitable. And so I have to ask you for some kind of mitigation, which, standard mitigation, the easiest thing to do is, hey, just put up some treasuries with me. We'll do a repo. We'll do a bespoke repo trade. That way, the risk on my end, the risk of this asset goes way down. I can easily fit it in the balance sheet like I did before. And by the way, that helps you too, because as a repo trade on the liability side for you, that should also change the model characteristics for your liquidity risks on your liability side too. So we have to now rejigger our balance sheet considerations to account for a much riskier world.
Jeff, let me go back for a moment to derivatives again, because I want to make sure in my mind whether or not the disuse or the lack of use for derivatives since 2008 is related to what we're discussing. So the BIS, they put together derivative tallies for all the global money centers. And then and they do that every 6 months. And then every 3 years, they'll do a wider survey of the world to get a sense of, what they're missing outside of the global money centers. And what you see, it starts from 1998. You see the classic exponential curve. And I think it reached like 700 billion or trillion in notional value.
Three-quarters of a quadrillion.
Right around 2000, right at 2008.
Yep.
And then just a steady for flat, and then in 2014, 15, 16 down, and now gradual modest increase, but essentially just a flat line across from 2008. Jeff, does that mean that before the banks were using those derivatives to satisfy risk measures, but now those derivatives are insufficient to satisfy the risk they perceive and thus they need more collateral? Or am I conflating two different subjects?
No, and I think you got it right, but there's actually more to it because there's two sides to the equation, right? As we're talking about here, there's always two sides to every transaction. And so, yeah, there was enormous demand. And those derivatives, credit default swaps, and the like wouldn't apply to the simple example that we're going through here. It would apply to some of the more complex financial transactions that would take place, where you might need, if I'm lending directly, a bank in the Cayman Islands lending directly to a risky corporation, for example, or buying an emerging market corporate bond in U.S. dollars or something like that, where I might need some kind of more sophisticated risk mitigation technique. Now, in the pre-crisis era, there was an enormous number of banks willing to provide that risk mitigation technique for me, and for a very small fee, because it was thought that this was there was no risk involved. This was just mathematical manipulation. We just got to do it just to do it in order to fit everything under our mathematical constraints. Since 2008, the demand for risk mitigation might be higher, but the supply that's what you're seeing in the BIS data. The supply is lower because the dealers realize there's more risk involved on our end for providing these risk mitigation processes than we ever thought. And the amount that we would charge for banks to do this probably makes it uneconomical for the transaction to take place anyway. So it becomes a systemic friction, another part of the global dollar shortage that we talk about, because risk mitigation, money dealing, all of these kinds of things, balance sheet capacity, design, and all of these other factors have become much more difficult to accomplish relative to the pre-crisis era.
And famously, it was AIG, not a bank, that was providing the credit default swaps for, I believe, the mortgage-backed securities or any number of securities, and they would not have made good on those promises unless the federal government stepped in the United States and made good on that. And so
and the reason AIG needed the federal government to bail it out was because it ran into a shortage of collateral. And so because AIG was short of collateral because of the way they were doing things pre-crisis era, that led to AIG becoming perceived to be, and in reality, a risky insurance company, at least some of the subsidiaries like AIGFP, which then put in doubt all of these credit default swaps that had been written. So we can never get away from the collateral shortage, even in that. But I think it's a very good point too, because I think as we're going to go along here, we're going to see that it's not just banks who we could call money dealers. Insurance companies play an important role, especially in collateral too. So, the category that includes this money dealing stuff is much, much broader than maybe people are led to believe.
Good. That segues perfectly back to our story. So in Singapore has been asked by the Cayman Islands to provide collateral. Guess what? Singapore, the bank doesn't have that collateral lying around. So like AIG, they're going to go out into the market and ask for collateral, but who are they going to turn to? They're going to turn to dealers for collateral. And so tell us the story now of these dealers. Who are they? Where do they come from? Who has the collateral that the dealers are using?
It's basically any large global bank that has access to financial marketplaces. And so, I'm a bank and you're the bank in Singapore. You need treasuries in order to complete this short-term funding transaction with this other bank in the Cayman Islands. I can do that for you. I might have treasuries in inventory because I'm I'm a primary dealer. That's part of my activities. I buy assets from the U.S. government, so I have warehouse securities of my own on my own balance sheet that I could lend to you for a small fee. Or if I don't have the collateral you need, I know people who do, who are insurance companies, pension funds, who are only too happy to try to enhance their low returns on safe assets by lending them out to me. So I have access to a wide variety of collateral sources, a large collateral pool that I could then give to you, for a small fee, that allows you to then complete this transaction with this bank in the Cayman Islands. So as far as the Cayman Islands Bank is concerned, you've acquired Treasury somehow, and if you default on the cash loan, the Cayman Islands Bank has the right to seize the collateral and sell it.
So for the audience, if you were following along, the collateral that's backing this cash loan,
this riskless loan,
was the collateral was provided by the Singapore bank. The Singapore bank borrowed that collateral from a dealer. That dealer possibly borrowed that collateral as well from an insurance company.
Or, as we talk about a lot, it's repledged collateral from one of its prime brokerage clients. That's really going back to what your original question was. What do the dealers do? This is one of a dealer's functions. How do I source collateral? And it's maintaining various sources of collateral, because all this stuff ends up becoming fungible. It almost becomes like its own currency. How do I keep, as the bank in Singapore is trying to manage its dollar funding with this bank in the Cayman Islands, the dealer has to manage its collateral funding, sourcing collateral constantly so that it can maintain these other relationships where collateral gets relent and repledged and all these other things.
And so it's like putting up your house as collateral, but then having a second and third and fourth lien, and people being okay with that.
No, it's actually putting up your neighbor's house who has pledged it to your other neighbor. And so your second neighbor has pledged it to you. So your second neighbor has to maintain houses to pledge to you because you constantly need that collateral. Otherwise, the Cayman Islands is going to say, I have to have the cash back, or at least I need to close out your liability, which would cause a balance sheet shortfall, which then causes the Singapore bank to have all sorts of problems because it's extended a dollar loan that it no longer has the ability to fund.
And in theory, this sounds enormously complex, as you're right, but in practice, it has become pretty much standard, repeated seamlessly on a daily basis. Incredible. But if balance sheet capacity generically is governed by risk, including judgments about volatility, then anything in the world, real or imagined, which could upset perceptions of risk and volatility might have a cascading effect upon the balance sheet capacities far and wide. So far, we've been talking about cash being collateralized, but then you bring us to this idea of what is collateralizing the collateral. Here, let me read it. What's the security for the dealer's security that has been secured by other means before it ever becomes collateral with seizure rights by this bank in Caymans? Or as you put it again, what's the dealer's collateral for the collateral it is repledging to be collateral further on after having it already been repledged into use?
Yeah, I have to apologize for the absurdity and ridiculousness of that. Good. But it's actually, it's to make the point here that it's not that far off from the truth. And really, if you're a dealer and I'm extending collateral to the bank in Singapore, or if I'm the dealer and I'm extending the collateral to the bank in Singapore, what is my security for the collateral, right? Because if you default on the cash, that collateral disappears to the Caymans. Suddenly, I'm kind of on the hook because I borrowed it from my prime brokerage customer, a hedge fund who actually owns the thing. I have to go into the market and replace it somehow, or by borrowing probably. So I'm going to collateralize the collateralized collateralization. And so, this entire collateral side of the SFTs, as they're now being called.
What does that stand for?
Secured financing transactions. It's essentially this amorphous pool of all sorts of funds and sources and redistribution techniques where, it's completely misunderstood. It's most often never even factored when it has proven time and time again to be one of the biggest factors in these modern problems. These post, in fact, 2008 was a collateral issue more than anything else. It certainly had less to do with subprime mortgages, and it had everything to do, as we just said, AIG failed because of a collateral shortage. And so what we're really talking about, we're really trying to understand is, what are the risks that could potentially disrupt these collateral chains and these collateral flow? For the Bank in Singapore, in order to maintain its funding of this US dollar loan that it's given to its local company, it has to have that US dollar liability. And as we said before, it has to have the collateral. Otherwise, the Cayman Islands Bank is going to say, I can't fit this unsecured interbank loan under my balance sheet. It's too risky. I'm going to stop funding you. I'm not going to roll over tomorrow. And so the collateral becomes that important. But what keeps the collateral flowing? What keeps that part of the tap, or what that part of the market on continue to work? And it's really what the dealers perceive, what the dealers are thinking, because they perform a role, they charge a fee, but they also take some risk in doing so. And they have to look at the bank in Singapore and say, is this guy going to screw me? Is he going to take the collateral and default? And so I have to have some kind of idea of what's going on downstream of the collateral, because I have obligations upstream too.
And so if anything were to spook the dealers, that would reverberate out through the system. And you make a key point here. You can see where we're heading here. If anything should disrupt these collateral streams, the issues this would create are: 1, not easy to identify; 2, not fixable by cash with quotation marks, or in any way the Federal Reserve's bank reserves. These currency-like properties of the collateral side of the global money system mean that it is a currency without backstop, governed only by the dealers who are central to it. Should we get into...
Just think about, in our simple example, what happens when the dealer says to the bank in Singapore, I don't want to lend you the Treasury anymore. You're the bank in Singapore, you're pretty much screwed. And so there's really not much you can do, because how else are you going to maintain your relationship with the bank in the Caymans? You'd have to sell some kind of asset in order to raise the dollars, assuming you have a dollar asset. And usually that's not an easy thing to do, because, unless there's a market for it, you're going to take a loss. And so the collateral starts to become a problem. It becomes a big problem.
And if the Federal Reserve goes to the dealer and says, well, we'll give you some bank reserves,
the dealer laughs.
That's wholly unsatisfactory.
Thanks, but we don't need them.
Yeah, because they need collateral. They need treasuries. They need collateral.
Or even if the dealer doesn't need the treasuries, because if it doesn't want to extend the collateral loan to Singapore, what good are bank reserves going to do? Are they going to extend an unsecured loan to Singapore? No, it's not helpful.
Who is Sebastian Infante and Zach Sarave? And what did they recently write about that's pertinent to our discussion here?
There are a couple of authors, I believe, at the Federal Reserve Board in Washington, and they wrote a paper in October of last year talking about collateral change. And I believe this paper was pointed out by another instance of a reader, a viewer of the show, who said, "Hey, look, you guys need to pay. You need to know that this paper was written." And so it was actually a pretty good paper, detailing some of the stuff that we just talked about and putting it into the more formal econometrics and regression analysis and things like that. And what they found out was that, yes, guess what? Treasuries get reused and repledged quite a lot. In which, I mean, anybody who's been looking at the repo market for any length of time would say, yeah, well, duh, we know this. But yeah, and I think that's really the point, is that, as we've said time and again, referring to Europe and the term SFT itself, this is emerging scholarship, at least in the official side, even though it's been going on for half a century. 50 years later, they finally get around to some of the more interesting aspects of what really happens in the modern monetary system.
I'm going to make that point that they made, and then I'm going to read a few quotes from them, and then you just jump in.
Yeah, definitely read the quote, because it was interesting that they started out by making that point.
Despite the prevalence of US Treasury reuse, its importance for market functioning and the financial stability risks it poses, the empirical literature on what drives reuse is scant.
I would say it's non-existent. I mean, scant is putting it charitably. And it's one of those things, to speak from a personal perspective, it's one of those frustrating things where you keep saying time, year after year, month after month, decade after decade, pay attention to collateral, pay attention to repo. 2008 wasn't subprime, it was a collateral shortage. And here it is in October of 2020 where somebody at the Fed is finally starting to say, maybe we should look at collateral. It's unbelievable, mind-boggling stupid, because the evidence has been overwhelming for that length of time. And that's really, I think the point is, it's gotten so bad and so overwhelming that even recalcitrant central bankers are now saying, maybe we should look at collateral. And by the way, as they write about in their paper, we're definitely going to be talking about March 2020.
Well, they say about March 2020, Treasury reuse reached its lowest point on record.
Yeah, but before we get into that, let's also state here that this paper used confidential inside information, call reports, bank stuff in real time that you and I, Emil, could only dream of having access to. And so it's another point of frustration. They have had all of this information in front of them for decades and did nothing with it. When there's those of us on the outside who have been looking at repo and collateral and trying to piece these things together, could only kill for that kind of information. And it explains why the world is so upside down. The people who have the information have no idea what they're looking at. And the people who would have some idea of what to do with this stuff can't get any access to any of this kind of information.
Well, let's see. I'm going to read a couple of quotes, and then they came to a conclusion. Here, they said a $33 billion increase in weekly Fed purchases leads to a 0.5 increase in the collateral chain.
That's a huge, I think that's, before we go, let's stop right there and talk. I mean, that's a big point. And it's one of the things that I've been talking about, and many other people, Andy Kessler from the Wall Street Journal wrote about it too, was that when they do these quantitative easing programs, it raises the level of bank reserves at the expense of pulling bonds out of the market. And if that quantitative easing program is targeting safe assets like US Treasuries to purchase, then what happens is the level of bank reserves go up, which we know means nothing, and the level of collateral available goes down. And so here's this Federal Reserve paper written last year that says, yup, that's what happens. When the Fed does QE, it takes collateral out of the system. And what has to happen, and what their findings, that quote you're talking about, what their findings show, is that the dealer system has to adjust for lower levels of collateral by reusing and repledging that much more to make up for the shortfall. Now, they kind of make it sound like that's a good thing. Oh, the dealer system is absorbing the Federal Reserve's fat butt, crowding collateral out of the system, when in fact it's really making it more risky because these collateral chains have to stretch, and it contributes to the pro-cyclicality risk behind it all. So it's not a good thing. And in fact, I believe, I don't know if you're going to get to the quote where they say, look,
interconnectedness?
Yeah, that one. Read that quote.
These observations combined suggest that the central bank can effectively reduce the interconnectedness of the financial system by reducing the size of its balance sheet.
Oh, you got to say it right. Really emphasize the word there. Reduce its balance sheet. The central bank has to shrink its balance sheet in order to reduce risk in the system. That's exactly the opposite way we're supposed to think about this. Because
I'm confused. I'm so confused. What are they? I'm just confused. It doesn't seem like what the Fed. Yeah.
What the Fed does is it pulls collateral out of the system, which forces dealers to adjust by repledging more, which raises risks. So in order for the Fed to reduce interconnectedness and lower those collateral chains and lower the systemic risk, they need to stop QE. They need to reverse QE. They need to shrink their balance sheet.
Yes, I agree.
So in order for the
central bank
to help, yes, for the central bank to help reduce risk in repo and collateral, they need to get smaller, not bigger.
You know what's so hard why I was confused is because I know the Federal Reserve had a hand in writing this. So
well, no, I think, there's another important distinction here. The staff level at some of these central banks is where some of the stuff is coming from, because the staff level can be more open to being open-minded. Whereas the top level policy people, especially, you just read one transcript from an FOMC meeting, you can tell these are just empty suits. who have no interest in believing anything other than what they've believed for 50 years. And so there's natural bureaucratic sort of institutional tension between people under the staff levels who are saying, this is what's going on. There's evidence is overwhelming. And then trying to forward that along to the top levels of the central bank, the policy levels of the central bank, and convince them, hey, everything that you've been doing for all this time is maybe it's not as good as you thought it was. And that's a difficult proposition. You can you can have a little bit of sympathy for Fed staff who are saying, this is actually happening. Here's the numbers. And a policy level central banker saying, no, you're crazy. There's no way we're harming the system.
Yeah, I was confused because this sentence makes sense. That's the worldview. That's how I understand it. But I knew it was written by the Federal Reserve. Therefore, I said, well, they can't possibly be saying that. They can't be saying something that makes sense. I must not understand the words that they're saying.
Right. The reason they're saying is the evidence is overwhelming. You can't.
Amazing.
It's been that way for so many years, and it's been tested, and we've seen it happen time and time again. QE is harmful. It's potentially harmful. And if you want to reduce the risks in collateral, stop buying bonds and taking them out of the system, which something you and I have talked about endlessly since, not QE or QE5 and, from 2019 to March of 2020, they committed possibly the worst error in central bank history by removing treasury bills at the worst possible moment. And here's this paper saying, reduce risk, smaller balance sheet on the Fed, when what was Jay Powell doing? Increasing risk by buying bonds, making these collateral chains stretch that much longer, dealers becoming more overextended in collateral side. Therefore, when the shit hit the fan in March of 2020, the system was in that much weaker, fragile state that really couldn't handle admittedly it was an enormous shock, the COVID shutdown, but still, there was no reason for it to have been that severe.
It was monetary malpractice, criminal negligence, what happened in September 2019. Earlier, you said that you've been saying this for years. Ladies and gentlemen, June 2013 just shows that you're not a Jeffrey come lately. Here, let me read it. June 2013. I have been pounding the table for months about QE and its inverse relationship with vital banking liquidity. In engaging in large-scale asset purchases, central banks, particularly in the US and Japan, are playing a very dangerous game. Despite conventional wisdom that when a central bank engages in such a monetary easing program, it must lead to an increase in liquidity, such a belief is far too simplistic. QE is actually the opposite of liquidity. Jeff, do you have any concluding thoughts?
Yeah, I think what's important about all that, just putting it into the time here, it took 8 years after those initial 4 QEs for this paper to come out. It was 7 years before this paper finally came out. So, it represents a step forward. But let's be honest, it represents a very small step forward, because the hill to climb here for the staffers who are looking at evidence and evaluating it with an honest eye, they have a huge, enormous task in front of them, which is to reorient monetary policy and indeed really monetary understanding in such a huge way that we shouldn't expect any fruits of this kind of paper to be evident for a very, very long time. So yes, it's good that this was written. It's good that this stuff is starting to seep its way into the mainstream. Again, going back to my personal perspective, I can tell you that there is more interest in monetary complications, Eurodollar, shadow money, that kind of thing over the last couple of years, but it is still just baby steps, and it is incredibly, incredibly slow pace.
Ladies and gentlemen, the holy metal that you need in order to kill any number of beasts is silver. You need a silver bullet, and they're very rare, and people think, well, that there's no silver bullet is the common saying, and there isn't in the offshore Eurodollar market. But if there was a silver bullet, it might be the Eurodollar futures market, which has been consistently right about which direction the global economy is heading for years now. And that's what we're going to discuss next in part 2. But first, this from Eurodollar Enterprises. Friends, are you a central banker? Do you celebrate monetary accomplishments before they occur? Do you struggle incredibly promising to be irrational? Then the new Clench 5000 from Eurodollar Enterprises is for you. Yeah, simply place this refashioned stainless steel mousetrap in your trousers or pencil skirt for your next press conference. Nary a hair will move on your head, nor an eyebrow raise in confidence. Nary a smile will cross your face before the policy transmits successfully through the economy. Rest easy that your days of premature celebration are over with the knowledge that the Clench 5000 is hair trigger sensitive. The Clench 5000, new from Eurodollar Enterprises.